Welcome to the show, guys. Today is Thursday, April 26th, 2018, and I'm really glad to have you guys here. Now, we're going to get right started by opening the charts right here. And now the first thing we're going to look at is the silver price. Get started on the silver price. Silver has been miserable lately. It's such a small little market, and it's so miserable. We have $16.50 this morning, and it's down a penny. Now we're going to take a look at cryptocurrency. We're going to take a look at Bitcoin. Oh, by the way, I'm going to try to explain to you guys a good way to look at the markets. As soon as we're done here, looking at these prices on these different things, I'm going to try to explain something to you about that. Okay, so Bitstamp is 88.62. She's down a little bit on the day from what it was. Let's go back a little ways. You can see where she's down. Maybe a 15-minute. Okay. What we see here is just like the stock market. It's just like descending stairs. The cryptocurrency market today, it's been down, down. Now, if we go back, let's see, we'll have to go back to like the 12-hour, okay, to see this pattern in the larger scheme of things when it was at 19,666. And it's dropped down, and right now we're on the upside right here of this descending pattern. It's very similar to the stock market, but here's the thing. I'm anticipating a little bit of a bounce in this as the stock market rolls over a bit further. And the reason why I'm anticipating a little bit of a bounce is, number one, the money doesn't. There's still excess liquidity in the system. And the money doesn't really know where to go right now. And they're going to start thinking Bitcoin. They are. Bitcoin is a trap for liquidity. And there's a number of things I need to explain, about this. But we're not going to do it right now because we're into going through the different prices right now. So let's take a look at the Dow Jones right now. She's up 58 points. I believe that the Dow Jones right now is probably on its way down to 23,000. And then when I think it hits 23,000, we're going to get a bounce. This is what I'm expecting. I'm expecting the Dow Jones to fall to 23,000, and then I'm expecting it to bounce back. I expect it to bounce back probably let's see, in line would probably be around back up to about 24,000 or so. So in its bounce, maybe up close to 24,000, long in there. I'm expecting it to bounce. So once it hits 23,000, I'm expecting it to drop down pretty soon. I'm expecting it to drop down to 23,000, and then I'm expecting it to bounce back some. That's what I'm expecting from the Dow Jones. But we'll have to wait and see what it does, because these markets are extremely unpredictable. I'm expecting it to fall and then bounce back. So oil, 68.42, and overall trend's been up. It's up today. It's up 37 cents today so far for sweet light crude, $68.42. Okay, bonds and rates. Let me pull the chart in here so we can see. 2.992. Now, the bonds have fell back a little bit, and the reason why the bonds have fell back a little bit is because the sloshing around money has seen the bonds at over 3%, and they've thought to themselves, hey, you know what? This is a good bargain. 3% yield, on the U.S. 10-year is a good bargain. So they've bought a few up, and they've knocked the price back down a little bit. The yield's down, I should say, a little bit. So the price of bonds goes up because they're buying. So a more expensive bond is a cheaper yield. So 2.99 fell back a little bit. I would expect this. In fact, I would expect it to fall back a little bit more, but it hasn't. And this is showing that the bond market is not getting the amount of buyers that it was getting. Simply put, that means that this condition that we're seeing is actually worse. So if it was a patient coming in and I was a doctor, I would say, hey, you know what? I've given you the antibiotics and your tonsils are still red and inflamed. You know, that's what I would say looking at this market here. And I would say those tonsils are going to have to come out. And in this case, this means that we're going to have a crash. You know? So I mean that's what it is. It hasn't moved that much really. You got a lot of buyers coming in, and it's went down to 2.992 from whoopee. It was like up to 3.02, I think it was, and it's come down to 3.99. You know, it's come down only very slightly, with a lot of buyers coming in. Because we're not getting the buyers we were before. The market is getting saturated with these bonds. The initial buyers have come in and they've bought up and they're all excited. Oh, I want some, and they bought them all up. But now those guys are all saturated with them now. And the guys that are coming in now, there's not as many guys coming in. It's waning off. Waning off on buyers. And in the end, we're not going to have any buyers for these things. And they're still going to come flooding in because this is what's happening. And so we're going to see yields are going to rise higher. This is where we're headed with this. Higher yields in the U.S. Treasuries. And as these pulses of buyers are coming in from places like the stock market. But you notice something? A lot of this hot money right now has been going into the U.S. dollar. And I figured this would happen. The dollar's the first one to take off. But it's going to be the first one to die. So right now it's taken off. Let's take a look right now at cryptocurrency market capitalizations. And it's a mixed bag today. You got a few coins that are up and you got a lot of coins that are down today. We got $396 billion in market cap today. Bitcoin dominance is at 38.1%. Bitcoin's at 88.92 and Ethereum 635. Ethereum's up today. Bitcoin Cash is up today. EOS is up today. Litecoin is down today. You know? So those are some of your top coins. And Bitcoin is down a little bit today. Neo is down a little bit. IOTA's up today. So let's see. The biggest coin that's up today is Bitcoin Cash, up at 3.46% today. Okay, so that's what your cryptocurrency market capitalizations are doing. The U.S. dollar index, 98.08 right now. The dollar is stronger than it has been. It was running around 89, and now it's back up to 90 and 91. It's climbing. And I expect as the market starts to cool off, I expect this trend in the dollar to continue to climb. It's going to climb until the Fed reverses policy. The dollar's going to stay strong until the Fed reverses policy. This is why the Fed is so intimate. This is why they're so intimate. What's the word I would use? Where they don't want to change. They don't want to stop what they're doing. They really do not want to stop what they're doing because they realize when they stop what they're doing, the dollar's dead. They're supporting the dollar, and they're going to try to support the dollar as long as they possibly can. They're going to stay on course with this reverse quantitative easing that they're doing, this quantitative tightening. They're going to stay on course with quantitative tightening because they know if they chart a different course, as soon as they turn around on this, that the dollar's dead. They know it. And of course, these markets, as long as the dollar is strong, gold and silver is going to be weak. As long as the dollar is strong, all these other markets are going to be weak. The stock market's going to be weak as long as the dollar is strong. And this dollar is going to stay strong until the Fed charts a different course. In fact, the dollar's going to get stronger. And the funny thing about it is gold and silver prices, like I say, are going to stay weak as long as the dollar's strong. Except, there's a huge exception here. Except when tremendous fear enters into the marketplace. Right now, it's greed. You know, that's what's in the market right now is greed. But when that greed is replaced with fear, they're going to run to safe haven assets, which is gold and silver. Then it's going to reverse for gold and silver. But right now, I mean, you couldn't get a more unwanted asset than silver right now, and gold. Nobody wants them hardly, except for the smart people. The smart people want them. The smart people are buying them when they're on sale. All these stupid people are going to buy them when the price is way up high. That's when they're going to decide to buy it. That's when the stupid people are going to buy it. And okay, so anyway, we've done this part of our market report. Now what we're going to talk about is you don't have to have a PhD in economics to understand better how the economic machine works. The economic machine being the world's economic system. An awful lot of these guys that have PhDs do not understand how it actually functions. And so they get it wrong over and over and over again. And the reason why is because they don't understand how the whole thing functions. To understand how it functions, you've got to think in terms of liquidity. You've got to form pictures in your mind. And one of the pictures that will really help you understand how this market actually functions is to think laboratory and test tubes. Think test tubes. Think a laboratory. Think the Federal Reserve is Einstein in the laboratory. Picture him with his hair like, Einstein. And picture that he's going around pouring liquidity into the tubes. Now, the biggest tube that he works with, that Einstein works with, is the bond market tube, which is a big, thick beaker. And it's a big, thick glass beaker, and it holds blue liquid. And this is all just pretend, by the way, but it's to help you understand how the markets work. So Einstein, or the Federal Reserve, pours this blue liquid in, which is his special blue liquid that he uses, and it's pure liquidity. It's pure money. It's money. He pours it into the system. Then from that tube, it can pour into all the other tubes and fill them all up with liquid, all of these other tubes. And so all the tubes get full and overflowing with liquidity. You've got a system that's going to be running better than if the tubes all get empty. If the tubes start to get empty, then the system starts to malfunction and not work properly. And that's called deflation. When the tubes are going empty and the liquid's being drained out of the tubes, that's called deflation. Now, when the liquid being the liquid money, it's cash in things that are very liquid assets. You could list gold as one of these liquid assets. Is liquidity. They call it liquidity, but it's actually purest form of money. And so as this liquidity comes out of these tubes, you get deflation. And if the tubes are overflowing, you get inflation. And so the Fed's in control over the level of the liquid in the tubes. And if you picture this in your mind, you can start to get a more clearer picture of how the system functions. Now, each tube is a different market. And so you get different color liquids in each one of the tubes, And what the Fed can do is they can actually take their big beaker, their big blue beaker, and they can pour some of that into the sink. And it runs down the drain. And then they can take some of the liquid from these other tubes and pour it into their blue beaker, and the other tubes start to go down. But the Fed only likes to pour a little bit to a time, just a few drops they pour into the sink. They don't pour the whole thing at once into the sink, all $4.5 trillion. No, they just pour 10 billion, which goes into 4.5 trillion many, many times over. I'll just pour a little, that's just a few drops. They just pour a few drops off the beaker, and then what they do is then they take a few drops out of all the other beakers, and you see these markets starting to go down. Or the reverse of that is when the Fed's pouring liquid into their beaker and then pouring a little bit of that liquid into all the other beakers. See? That's the reverse of that. So this is what we see exactly. We see liquidity is chasing yield right now, but they're getting scared of bonds right now. That's why they didn't pour so much liquidity into the bond tube or the bond beaker this time. When it went up to 3 point, when the bond yields go up, that's the liquidity going down in the blue beaker. Okay, so the liquidity the bond yields went up over 3%. The liquidity in the blue beaker, that's the big blue beaker, went down a little bit. That's the level of the liquid in the blue beaker, right? And these other markets, like the green beaker, would be your, which is another big beaker, which would be your stock markets. Some of that liquidity come out and it poured into the blue beaker, so the blue beaker went up a little bit, but not as much as you would expect, because some of it now went into the dollar beaker, right, which is another big beaker. Say it's a red beaker. And some of it went into that beaker, and that beaker went up quite a little bit. It went up from 89 to 91, you know. That means that the dollar now is absorbing liquidity. If as much liquidity was absorbed by the silver market, which is a skinny, skinny little beaker, it would raise the level massively if as much as went into the dollar, because the dollar is a big fat beaker, and you can put a lot of liquidity in there and not move the level much, see? So you picture these beakers, the liquidity moving from one beaker to another beaker. The most sensitive beaker of all of them is the silver, little skinny silver beaker. It's only the size of a straw. It's so skinny. And so if you put a drop of liquid in that, you actually move the level a lot, see? Whereas if you put a drop of liquid in the big blue beaker, which is the bond market beaker, you can barely see any movement at all because it's such a big, thick beaker like this. It's like this big around, you know. Whereas a dollar beaker is a nice, big, thick beaker too, and so is the stock market beaker's fair-sized, you know. And all these beakers are different sizes. And so the liquidity inside these beakers moves depending on how much liquidity they can hold. The most sensitive beaker of all, though, is this skinny little silver beaker. You know, but also you have to understand that that little skinny silver beaker is the one that can break everything. It can smash all the other beakers and destroy the entire laboratory. It is nitroglycerin inside that silver beaker, you know, because it can blow up everything. If that beaker, that's the most sensitive beaker of them all. Anyway, if you form the picture of these beakers in your mind, and you can see when there's a set amount of liquidity in the system, and basically the liquidity is just moving from one beaker to another. And so if it comes out of one market, you have to see it move into some other market. So what you do is you watch to see on these numbers here which market this liquidity is moving into. And I quite figured that the liquidity would move in to the U.S. dollar index and into the U.S. dollar at a certain point. And I also figure that the liquidity is going to move when things change from greed to fear, that it's going to move into gold and silver too. And these are the three places liquidity is going to go in the end. But it's misplaced to put it in the dollar. They're only going to do that because the dollar's going up. They've started to see the dollar go up already. They're going to see it go up more. As it goes up, it's going to give them confidence, and that's where liquidity is going to pour. It's going to pour into the dollar. So thank you guys for listening. Like and subscribe, and we'll catch you in the next episode. Bye.